This is Justin Pulitzer. This is my weekend review video for Sunday, April 24th, 2016. An amazing amount of information to cover here. I'm going to start out a little bit differently this week and start with the economic calendar because there is quite a gauntlet to navigate. Then I'm going to flow into the 6 market keys, hit up the 7 Fed keys, get into the major market indices, and then talk some stocks. We have the balance of the FANG trade, they report this week. We have some important biotechs, and then the big oils at the end of the week. So Monday starts out, we have the new home sales. That's an important number. More importantly is going to be on Tuesday, though. We have the durable goods orders. That's very important. And the Fed meeting here begins. So you also have the Richmond manufacturing, some consumer confidence, Case-Shiller. These are some important events that are taking place. Wednesday is the big day. We get the Fed decision at 2 p.m. That's going to be very important. We also have the petroleum status report. Then Thursday, we're probably going to add on to the Fed issues here. We have a GDP, jobless claims, PMI services flash. That's going to be an important one. And then on Friday, there's no rest for the weary here. We have personal income, Chicago PMI, and then consumer sentiment. Those are very important. With regard to the Fed, not very much expected for this particular meeting. You can see the probability of a hike here is only 2%. June, not that high. July, not that high. September, not that high. However, November now is creeping up a little bit over 50%. I would think that this is probably just a little bit of positioning. This had been well below 50% for a while. December now looks like almost like a dead lock at 66%. I'm curious to see how these numbers are going to play out after the Fed on Wednesday. The Fed is going to be very important. I said on Friday in a tweet that I said that I think we're at a point for the S&P here where it's sort of the red pill, blue pill moment. That, of course, refers to the Matrix when Morpheus offers Neo the blue pill. He can, wake up in his bed and it's like nothing ever happened. And then, of course, if he takes the red pill, he travels and, he's going to basically discover the Matrix. So that's really where we are. We're at some really, really key levels in the indices. We're at some big levels in stocks. And I'm going to navigate you guys through what I see here. So there's sort of mixed news. There's a couple of ways you can interpret this. Of course, people who are bearish always see everything as bearish, and then people who are bullish always see things as bullish. I don't really consider myself either a bull or a bear, believe it or not. I tend to just trade along the line of least resistance, so I can be playing long or short. It doesn't really make much of a difference to me. However, this is encouraging. It's hard to say it's not. You had this period of relatively benign volatility for a while. You sort of got the flash crash. We had this spike. However, it was starting to look like we were transitioning from a period of low implied volatility to a period of more high implied volatility. The dreams of that for the bears here kind of came to an abrupt end when we broke trend. See, we were starting to make higher lows, starting to make some higher highs. This one sort of was a little bit of a chink in the armor with regard to being a lower high. And now any attempts to move back into the channel, and there have been several, have been sold, rejected. We are kind of getting to the lower end of the range. I don't really support selling volatility here. You can see I made a key. If you want to take a pause and read through those numbers, I encourage you to do so. The point being here, though, is I think the trend. And the trend here is for a little bit lower volatility. I could easily see us having one of these periods where it does get a little bit choppy down at the bottom. Maybe we do have some intermittent periods of, spike highs. But it seems like the market is feeling a little bit better about the world and itself. You can see, the attempts at the VIX rallying have not gone over very well. Famous last words, of course. I would wait, to heavily long up here to see if we definitively get a new low in the VIX, or if there's some type of, a buy the dip moment. My concerns are numerous, as they often are. First and foremost, we had this really, really big ramp in the dollar. This is the dollar ETF, the UUP. I have talked about a range, a consolidation range, and moves on the lower part of the range have been unsustainable, as have the moves to the upper part of the range. However, the moves to the upper part of the range are a little bit more sticky than the lower. You have a higher low here, a bit of a higher high. It seems to me like we may make a move to this regression line, and we do have the Fed coming up. So it might be prudent to be cautious. That would also take us to mid-range, to this big volume distribution. A little bit cautious. I probably am not going to be doing very much trading on my own until, other than, some intraday stuff, but no major positioning until after the Fed. I'm not really expecting the Fed to be all of that hawkish, but I don't necessarily know if what they're going to say is going to be dovish enough to get us a definitive break below this range. I will tell you this, though. If this range really goes and we lose it, it's going to be the market sailing into the wild blue yonder, potentially. It just seems to me that a weaker dollar would do wonders for oil. It would do wonders for foreign earnings. We all know the earnings have been coming in rather crappy. There's no way to sugarcoat it. Have not been doing very well. So that's the dollar. The gold, the GLD, has broken in a very long-term downtrend. It's at a volume distribution. My little concern here is that it could be forming one of these jobs, the little head and shoulder tops. I identified a neckline here that I do realize it's below some of these tails, but these bodies here, if those start getting violated, it's not going to be pretty. I don't necessarily know that this is really what this pattern is going to amount to. I think it's a bit of a stretch. To me, it just really honestly looks like a bit of a bull flag consolidation. But that doesn't mean that there can't be more pullback. You can see the 50-day here was a lot of support. We had a close here, not confirmed here, another close here, not confirmed, it's rejected. Now we have another close below. I don't necessarily know that I'm all bared up here. Anything below 117.77 gets a little iffy. The close here was still above there. I'm thinking that this probably is just going to consolidate for a while. If the UUP does rally, this will come back and give an opportunity to buy. I'm thinking somewhere along. Let me get rid of this old Fibonacci. We don't need that. I'm thinking somewhere along the backside of the breakout could be, like if this had like some kind of a sharp move down into here, basically where the real breakout was, up above the 113.25. I think that area would be interesting to me for a right or right out trade, particularly if it came down multiple days into there and got itself, oversold. I will tell you this, in my experience, gold loves 61.8 Fibonacci retracements. It would not surprise me in the least to see it come back down into that region. But we do have, that would be quite a large pullback. I think it would shake out a lot of this chase. I don't necessarily know that you're getting that, though. I just think that we're getting a bit of a consolidation, and I think that at maybe the 38.2 is sort of the break-off here of this volume distribution. It's also the breakout here, so I'm thinking around here is probably a decent right or right out trade opportunity. The bonds. All right, so this is starting to look a little bit familiar, this pattern here. It's starting to actually look a little bit like this. And we know that this sort of fell out of bed at some points. It doesn't surprise me that that could happen. Look where we are. This is going to depend a lot on the Fed. So I've said for a while that interest rates here the bonds don't necessarily need to rally, and you don't really need rates to fall. You just really can't have rates spike higher, because the thesis here of the higher stock market is predicated. We know earnings aren't good. We know the economy's not good. We know the world isn't in a good situation. The thesis of higher stock prices and a PE multiple premium, if you will, is predicated on this, meaning lower for longer, lower than expected yields, and the Fed to remain accommodative for quite some time. I don't necessarily know that I've seen anything in the numbers that would really warrant the Fed to get very hawkish. We heard Yellen's last speech, and she was probably the most cogent and dovish I've ever heard her. I don't know if she's going to try and walk some of that back or how that's going to play out at this meeting, but I would assume it's really going to be more of the same because the numbers that have been coming out have been quite atrocious. I don't want to necessarily steal the thunder from the 7 Fed keys, although maybe this is a good point to interject into them. The jobs numbers, the NFP, the non-farm payroll has really not been that good. I know the headline number, everyone's excited about the 4.95%. The problem is that the under the hood of those numbers are really not that good. You have a lot of part-time jobs. You have waiters, waitresses, bartenders. I often joke about carnival ride operators, but that's actually a thing. It's Caddyshack season, right? You got guys working at the country club, and even they were replaced by golf carts. So that's also been one of my big themes, by the way, automation and AI being a game changer with regard to employment numbers. I think that we're in a situation here where we don't only have a cyclical situation, which is that the ups and ebbs and flows of a business cycle, but we have a structural unemployment issue based on the advances in technology, i.e. automation and artificial intelligence, which I think is really coming online in a major way. How people shop, how people do business is very different than it had been in the past. You have real-time supply chains, which is great for preventing inventory recessions. That's sort of what starts off all of the major recession, depression. That's what really kicked it off for the 1929 crash that everyone knows about. I don't necessarily know that the Fed is going to, I've heard them mention technology, but I don't think that they are fully aware of the extent of what's going on here. I think that they're slowly waking up to that fact. I just don't see the jobs really ever coming back. It's not like, companies are going to say, okay, with the Obamacare tax, let me hire more workers and spend more money when I could hire a robot and just, have a maintenance plan. That's a lot cheaper than hiring employees. It's also a lot cheaper to do business overseas. That's why you've seen all the offshoring and the corporate inversions and such. So, my opinion, the jobs are not coming back anytime soon. The GDP has been pretty cruddy. We know that the first quarter, it's been weak for the last few years. It seems to be like a new norm of a slow first quarter, although things haven't been doing so well lately. So GDP, not so great. We just saw a Philly Fed reading the other day that, honestly, that's like the kind of thing that if you're on an airplane and you have your barf bag, you want to have it out. You're in like some major chop and, you're just hoping to keep your the cheap dinner they serve down. Really, really crappy numbers. ISM has not been anything to write home about. The manufacturing or the service, not particularly well. The PMI, not that great. The durable goods numbers, we're getting a new read on that this week. I think that's Monday, which is good because that's in front of the Fed. If that number comes in like super-duper strong, you're going to get people worried about the Fed. For me, I just don't. Again, I'm not really that excited about these durable goods numbers, and I'll explain to you why. I think the peak auto thesis is correct. I think that autos have been good because we have low interest rates, but if interest rates start rising, that's going to hurt the auto sales. Also, what's been going on with oil? Oil has been down ginormously. I don't want to get into that right now because I want to come back to those things after I finish the 7 Fed keys, but we all know gasoline and oil have come down, and the more higher end, I guess the higher margin SUVs have been selling again well, so very contingent upon that. We know aircraft sales have not been particularly great. Housing has been good. I will tell you this, I think a lot of the demand for housing has been pulled forward thanks to the warm weather. Excuse me. We had a fairly mild winter. You've had construction projects. Those construction numbers have been great, by the way. I have a lot of new construction in the neighborhood I live in, and none of it, zero, ceased in the winter other than for a couple of days. They're all majorly ahead of schedule, and that, I think, has been playing into these great housing numbers. So I don't necessarily know that, yes, the total number is great, but when you kind of seasonally adjust it for what took place here, I don't know that it's as stellar as everyone realizes. And then, I had made the joke that after 10 straight months of hiding under your bed and desk and stuffing money in your mattress, people came out and bought some toasters. I don't necessarily know if you buy one toaster, there's no upgrade cycle really on toasters. You kind of do it until it starts burning your toast. There's no subsidy. There's no fingerprint identification. There's no, better screen coming out like the iPhone. So, a toaster is a toaster. Yeah. So this is what we have to keep in mind here. These 126s to 127s have been a key support. I think we could even maybe come down a little lower to see the trend here. It's possible if we get a bit of a hawkish Fed, there's a break, and we see a 200-day moving average. Look at what happened here. Once you broke below the 200 here for a while, it moves above it were not sustainable. Look at this, all of this chop. Finally, we get out of the gravity of the 200 MA, and we've never retested it. So I think it's possible that we do have a retest of the 200 MA. It would coincide with the channel. I think it would set up for a great write or write out opportunity for a buy. But being said, it would be off of a lower high and with a lower low, so it would have to be done cautiously. Anything above 123.15, even if this does come down, is still relatively bullish in terms of low interest rates and the PE multiple. But I do think you'll get people a little bit iffy given where we are in the range in SPY, which I will get to shortly. HYG. This also, the rally here is taking a lot of pressure off the Fed. We basically got just short of the 61.8 by just a couple of ticks. It's rallied back up. It formed a bit of a V, kind of cup and handle here, rallied. It's above the 200 MA. You can see here 200 MA was resistance. We haven't even touched the 200 MA since back a year ago, and now we're above it. So there's a little bit more room here. This could, if this does rally, that would be good. I think a lot of this has got to do with energy and oil, and the fact that as energy rises, the fear, I guess, of these, the high yield going bust is mitigated. So that's what I believe. This is reflecting the commodity rally and the possibility of bankruptcies are coming off. Speaking of the commodity, oil. Holy cow! So we got a bit of a bullish situation here, right? Higher lows, higher highs. You had a bit of a double hot top here that failed and it broke out. You are coming into some side, I guess, past support or a congestion area, some horizontal resistance. I don't necessarily know that this is going to be a straight shot up, but the backside of the old uptrend line and the resistance here was in 49s. That's also the channel high. I think that's where we're going. We're well above the 10-day here. I mean, listen, it's always possible we pull back and get a trend touch, but I mean, look at this: higher lows, higher highs. The pattern to me is shifting. It looks like oil wants to go higher. I think this is where it wants to go. I think it could even possibly get still higher up into the 54s, maybe even 56s, but for now, I'm talking about 49s. That's my story at the moment, and I'm sticking to it. XLE, another fine young cannibal here. No, I'm joking. 200-day moving average broke down. We haven't touched it in, since maybe my bar mitzvah. You have a nasty, nasty downtrend here that broke. I mean, we are now making higher lows and higher highs, and we're well above the 200 MA. Look at this. We got the 200 MA. They had the attempted pullback. Look where this stopped to, by the way, almost to the tick, the backside of the old downtrend line. And a very, very powerful, potent reversal off of that and a move higher. I don't really see anything that has caused this. The inventories have been terrible. I mean, all of the data that's come out for oil has been bearish, and pretty much all the selling has been met with buying. So bullish oil, that also, by the way, if this starts getting way too bullish, could start putting the Fed back into the picture. So we sort of want a Goldilocks scenario here, this sort of slow grind. You don't want any really flashy big moves to kind of attract the Yellen rate hike wackarooski. Unfortunately, it'll eventually have to happen. We all know that, but from where it comes, who knows? Seems to me, though, that the pattern here is changing and looks a lot more bullish. So who else is dependent upon oil and these things? The Chinese. We held basically the reference low here with a look below and fail. We've broken the downtrend. We're coming up. We're still below the 200-day moving average, and we're coming into a volume distribution. So I don't know that this is just going to start really ramping, but I can tell you this. It seems to me that there could be a little bit more upside, but it might just be in a bit of a grinding, choppy fashion given the type of damage that we've seen. The good news, though, is that we have higher lows and some higher highs. We are in a little bit of a consolidation pullback here, but as long as trend holds, you guys should be kind of okay with that. One concern I have, I know a lot of people are piling into this Alibaba. This spike, I looked at it before I started recording. I don't believe it was real. I think it's a phantom spike. That said, we are clearly in overbought territory. Look where these lows, look where this range was, this consolidation range. We are coming into the meat of that. There was a gap fill at 81.27. I know everyone was all bulled up, and I mentioned that this area was going to be a bit of a sell. You had a bit of a double top here. I believe that this day is actually lower here, so it didn't really have this spike, and it's just pulling back a bit. You really need to see it hold this 77.77. That's the edge of this distribution. You have this is 77.71. So yeah, so this swing low really needs to hold. I do think that the pattern is starting to shift and look a little bit more bullish, but I would be more of a BTD guy than a chasing for the breakout here, given the fact that you have multiple distributions up here of people who bought and are now being first made whole. And I just don't think that this is going to kind of sail into the wild blue yonder that easily. I think that there is going to be an opportunity for a pullback and to buy into that. Listen, I could be wrong. It could easily come up. There is room to 86. That's where this topped out the last time. It just seems to me that buying up here after a gap fill, a very prominent gap fill right before the main breakdown took place, there's going to be people up here who want to get their money back and they're excited. Look where this volume distribution really begins. It's right at that gap fill. Look where the selling came in. It's right at that gap fill. So the best thing I think that this could do is just kind of consolidate sideways. You don't really want to see it give up much more than half of this range. You have bodies in here in the... and this worked because it's the 78s. I wouldn't feel comfortable really if this started giving up more than like the 78s, 79s if I were long. I'm not. And like I said, buying up here is not nearly as good of a buy as, down here. You were down at 59 and now you're up in the 80s. So pretty much in a straight line with a little bit of consolidation. So it doesn't surprise me that there's a little bit of selling up here. There might be some profit taking also ahead of their print coming in. The biotech. All right, so we have a bit of a W pattern here coming out of this consolidation at some very key reference areas. Look where the breakout was. Look where this W, the neckline of the W basically is. It's just below there, the consolidation. This, to me, looks like it's trying to improve. I think that it's good that this sort of is forming a flag. I'm a little loath to believe that this is just going to completely fly up, given the political climate we have with Hillary Clinton, Bernie Sanders, and Trump all talking about lowering the the pricing of drugs. I think it could rally back up, maybe to test the backside of the old uptrend, see where it snapped. It got the snap. Maybe we're getting the move back to it. So that is what I'm thinking. Some of the patterns in some of these stocks have been looking good. I'm in this ALKS. Amazingly great trade location on this. I've been discussing this for a while. We're into the gap here. You can see there is some past volume here. We're actually into a volume node, but you have a bit of a price void here, and gaps tend to like to fill. I don't know if we're going to get 100% fill here, although that would be very nice. That's really where this breakdown took place. But I think at the very least, it probably sees one of these Fibonacci levels, maybe the backside of the old uptrend line up here. So a couple of things I liked about this, that this didn't just kind of go into the gap and then come down. It ground here, it consolidated just below it, consolidated, and now is into it. I think you could remain long over 40.28 if you're kind of new to the party. Anything below 40.28, you probably want to use a stopper-ruski. Yeah, that's just my theory on it. I think that this could pull back, believe it or not, and see the trend. I don't really think that would be all that bearish, believe it or not. I think it would be actually healthy. But I am thinking that this ALKS is trading like there's something going on in the stock and that it probably does want to go higher. Who knows? Maybe it's a takeout at some point. I don't know that it is. I don't know anything, but I just know that the thing is trading very well. Gilead also clearly getting into some overbought territory, breaking a secondary downtrend line back here, and now it is breaking the primary downtrend line here. Let's zoom in a little bit. This is a big volume node, also where the breakdown took place from the 101.19. After that gap, it kind of never recovered. So it doesn't surprise me that it might find a little bit of resistance here. It's also a 50% fib of the entire range. Some good news and some bad news here. The good news is that it is above the downtrend. It is above the 200-day moving average, and the pullback here wasn't very much. This actually closed kind of toward the upper part of the range. Pretty bullish. The bad news is that it's rallied multiple days, also ahead of their earnings. The risk reward becomes less than it was down here. My thinking is that you could use this day's range. Anything above 102.45 is bullish. Anything below 100.5 starts getting a little bit more iffy for pullback. It may come back. If this does something like pull back, pretty majorly ahead of their numbers, like into some of these reference tails here in mid-90s, I think that could set up for a shake and bake type of a situation for a buy, particularly if it's on channel low. If we stay right here, maybe there's a put ratio or something to be played for earnings. Let's see how it trades ahead of there. I do think, though, that this is looking better. Like I said, the same problem with Netflix. After you've had, kind of a big steep decline and you have this bit of a grind back up, and listen, this could gap and go. It just seems to me that it's probably better to start booking some profits now that we're into some reference levels. Let's talk about the indices, the SPY. So you had this move, you had this sort of big consolidation I've referred to as sort of the mountain, and now I said we were kind of trading potentially on the wrong side of the mountain. The good news here is this. These lows have been tested and retested, and they held. I think that the Yellen speech was a game changer. Listen, she can change it again if she wants. But we are really... This should, check this out. This came down, higher low, and a rally back. This is a very normal type of a situation before a bear market starts. A bit of a lower high here, you came back down again. It really shouldn't have been back down here again so soon, in my opinion, and it held. You had a W pattern to the upside. The market should not be back up here. This to me was the kind of the double bottom, came up. This was again a double bottom, back up. If we were really bearish and rolling over, the market wouldn't be back up here. This is like spitting a stone's throw from all-time highs. So the good news and the bad news. The good news is we broke the downtrend. You can see the downtrend here was broken. We are back up into some resistance areas, however, and we did basically rally in a straight line higher, more narrowly focused. This is the Yellen day. We were starting to roll back over. I mentioned that I thought this was very possible. This was a bit of a game changer. I know a lot of people this day thought that I asked if the market was bullish or bearish, and this was breakaway value, by the way, and everyone was saying, oh, it was bearish. I said we had a multi-day consolidation and we are above the high. This was a 1, 2, 3, 4, 5, 6, 7, 8-day consolidation with a gap above the high, and people were still bearish. Look where it came into, the 206.76. We backed off a little bit, held here, had a breakdown. This was okay. The fact that we held the 204, I said it was very possible we'd fill the gap, maybe see the 204. That held. The next day, again, everyone was super bearish here because it wasn't just rip-roaring. This, to me, was actually a bullish day. This, however, was not. This should not have happened. We should not have retested these lows again. I guess the market agreed with me, came back up. However, the next 3 days, it spent kind of opening a little bit strong, although I guess not stronger because we were below this high, but opened here and basically sold off. Again, opened near the highs, sold off. Again, opened near the highs, sold off. This was all happening. People were terribly bearish. We were retesting this 204s so many times. It struck me as funny, and I said that they're selling it off with days with positive or flat breadth. I mean, this wasn't real selling. Finally, it resolved higher, which is really what it should have done given this type of internal situation. Broke the trend and now is just gently pulling back here a bit. I know everyone was like trying to, I had some people ask if this was a shooting star. This was just overlap of range. This, however, could be a bit of a secure high. You have a high bookended by 2 lower highs and a move down. It needs to kind of confirm. This has been even this day when we were down at even near the lows. The breadth was really not bad. I mean, you're talking about like 1 to 1's negative, 2 to 1's negative, even 3 to 1 negative isn't that terrible. We weren't even seeing that. Look where the close was here. If you guys ever kind of wonder if these levels are real or they work, 208.97, close here was 208.97, and Friday's close was 208.97. So this is really a very key battleground. Moves above the 208.97 have not been sustainable. We need to see if the bulls can get over it. If you can get over, I think, Friday's high of day, I think the trade is long. Below the low of day of 207.91, it could get a little bit more squirrely down to the gap fill here of the 205.92. I wouldn't necessarily think that this is completely bearish if we did sell it down here, given where we are in the range. Look at this. 210, 210s to 211s. What was the high here? 211.66. Look at these highs in here. These are like in the 210s. This area has been points of major contentions the last 2 times. This high was 211.66. This high here was 211 to the nose. This high here was 210.92, basically 211. So it doesn't surprise me that there was just some people who were saying, okay, we got back up to the old reference high, basically. Let's just book some profits. The question now is going to be is what I always say, when you get to a reference area, is the pullback sharp or is it shallow? A shallow pullback to me bodes well for a move still higher. Look at this pattern that we're forming here. It's a giant W. That is a bull pattern. I'm thinking if the Fed doesn't get crazy and Yellen is dovish again, it wouldn't surprise me to see some type of a blow-off rally and the market sail into the wild blue yonder. People forget before the crash in 1929, the market was roaring that entire summer. It basically peaked in the summer. I don't think we're in a scenario like that for multiple reasons. I know growth is crappy. I know that, I've outlined this scenario about, terrible jobs. I don't necessarily know that we're moving into, a multi-year depression right here and now. There's going to be a lot of Fed action. The Fed has said that moves in the market downside have been mitigated because there's an implicit expectation of the Fed intervening. We know from Yellen's, I'm just looking at my notes from the last meeting. I think this was on 2/16 when they gave their press conference and the big, Yellen kind of, laid down the law. They were very worried about global risks. I mean, we have a Brexit potentially. That's the British exit. We know Greece is going to be coming into focus again soon with them and their litany of debt problems. They talked about inflation-adjusted incomes being okay. The only problem is there's there's really not that much inflation. We know that they've talked about. We know that they've talked about their fear of global concerns. That is going to be the key, by the way, in the meeting on Wednesday to hear what they have to say about global concerns. And like I said, with the British on the verge of exiting the Eurozone, it just seems to me that they're going to kind of cool their heels a little bit here. They talked about a neutral Fed funds rate being historically low for a long time. They talked about holding positions even through normalization. They even hinted that they'd be comfortable with some inflation. I just can't see, after we spent this much time with below trend inflation, meaning below their target of 2%, that they're going to, think that it's time to hike rates. It just seems to me like the Fed is on hold for a while. They may talk tough, but I can't see them really coming out of their box here. And, just after Yellen's speech, basically saying that they see the risks to inflation being to the downside, maybe for multiple years, by the next meeting, it's rock and roll to raise, to really start hiking rates. I do think that they may raise rates in December, but I think it will be maybe one of those one and done things. I just don't see it happening really right now before then. We'll have to listen. We'll get more information on Wednesday. Given where we are in the range, I think it's prudent to kind of just hang out for a couple days. The weather might be warm, drink a few beers, and just, make a couple of intraday trades. No need to load up on heavy positions ahead of the Fed. I think after the Fed, that will set the trend potentially either, for a summer rally or for a more steep correction pullback, maybe down to the lower end of this range to the 201.90 level, really where this all began. Really right around here when Yellen's, got religion, so to speak. So we're holding the 10-day moving average. We're holding the 208.97. For an immediate trade, I like above the high of day long, and I like below the low of day for more of a gap fill. So that was the long win. That was sort of the long way around that conversation. The expected move, by the way, for next week is not very much. I'm looking to the expiration. It's below $3. It's $2 and basically 80 cents. So that would take us up to 211.77 or down to 206.18. I think that if it's to the downside, it obviously would be a little bit more, and we probably would get the gap fill. That's sort of what I'm thinking. IWM. Let's take a look. I've been using this less and less. I'm finding it a bit of a red herring, so to speak. Look where it's sitting, though. Look where we're consolidating just below the box, the big consolidation box that once, we kind of broke out of range. Some good news here is that we did break the downtrend. We are above the 200-day moving average for the first time since, look, where the breakdown took place. The retest of the 200 failed. Here we couldn't even get to it. Now it's over it. There's a lot of volume distribution here. It's good that it's consolidating. Above the downtrend, above the 200, above the 10-day, above the gap fill, it's all good in the hood, right? I want to see how it handles a move into this range. If it's rejected immediately or if price accepts. Like I said, we are coming into some very, very key areas for this IWM. The Qs. Showing a little bit of weakness here. We know the fangs are basically, I don't know. They look like that there's basically money rotating to me. That's really what it looks like. It just looks like that's where everyone was hiding out in these high growth names. And if there's some expectations here of maybe a new economic cycle, that some other names are getting some love now too. Also a bit of a W pattern, although this is a lower high. I'm acutely cautious of this. Look where it kind of topped here. It was basically to the bottom area of this consolidation. It does not surprise me to see a little bit of pullback. It is still above the 200-day moving average. It basically got one Fibonacci level to the next. That's very healthy pullback. This could even, believe it or not, just come down to the 50 and still be fine. That was support here. Look, it finally broke out. It supported. So I'm thinking the 50 and somewhere between the 50 and the 200 here should support. The little bit of the concern is that we are looking like there could be a mini forming here. I'm just, this is just thinking out of the box here. Like this kind of like form these mini rounded tops. It could be one of these, and it could have a bit of a breakdown, but that's really reaching. We're well into this, area. There's not that many people, I would say, who are underwater. And as long as you're holding this, the 105s, it's really kind of okay in my view. What could cause some issues here? The FANGs. So Apple. Apple's not really a FANG, but it's a big momentum stock, and it's a very large part of the S&P and the NASDAQ in particular, the Qs. This is rolling over a little bit. I had said down here I was starting to get bullish once we broke out of this range. It got the downtrend. It had a very shallow pullback and then was basically up here. You had this washdown job from Nikkei. It came out that Friday. This was an options expiration, and it was real true effery. I think that this was just so obvious that it was the market makers looking to pin the stock. But, when you do get a reversal like this and back below trend and, everyone sees how easy it is to kind of push over the Tin Man, shorts get ideas. And it's been coming back down. Many of you will know that I often affectionately refer to this pattern as the shake and bake. The best thing that can happen is, in my view, is that we're down again Monday, and then it's weak again on Tuesday, and we're down into like a fib level or something, or it's gotten really steep, and then the volume is starting to rise, and everyone's wondering what's wrong, and then they'll rip this thing back up in your face high for a nice little boost. There's a couple of, and we are coming down into an important level, this 103 level. I want to show you on a longer time frame. 3 years might be enough. Looky here. A lot of consolidation here, and once we really got the move over that range was when you got this big rally. There was a bit of a pullback, which stopped just short of there, but that was really where the big rally took place from once you got this gap and go move. So this area is an important point of contention between the 103s and, like, let's say the 100s. And you also have a 50 and 100-day moving average. I think the 103 is a good spot to maybe start selling out of the money puts if you are so inclined to in Apple. The problem for me with Apple is that this quarter should really be nothing to write home about, and the one at the end of the summer is probably not going to be anything special either. There's no new iPhone sales into there, so there's no catalyst. You do have Worldwide Developer Conference coming up in a couple of weeks, so that will be a catalyst for Apple to have a bit of a rally, but I don't really see anyone getting super-duper excited about this until we get closer to the iPhone launch. So I don't really see any urgency in regard to Apple. If anything, I could see a lot of people starting to get worried about Apple, talking about one of these type of situations, a big kind of head and shoulders top with a neckline breakdown. This could be the throwback sort of to that neckline, and then it's going to collapse again. I don't necessarily agree with that, but I will tell you it's a very possible, a little bit cautious with Apple. There's just really not that much to own here ahead of the the iPhone launch. This will probably get a little bit more interesting to me later in the summer. But for an immediate trade, the 103s to 100s, I like selling out of the money puts when it starts touching down into those levels. Facebook reports next week. The expected move for the week is about $8.16. This, we know, has run up a lot on Google earnings in the past. This time, Google was not good, so it's coming down on Google earnings. I had warned that people might get a little worried about a double top. We were also hitting into the progression line. What do you know? It's showing where it should this time. Sometimes this shows up in the 118s for whatever reason. It really is in the 116s. It's very, very annoying to me that it does this. And the screen is frozen. Even better. You'd think you can't make this stuff up, folks. All right, so my theory about this with Facebook is that I think that a lot of the Google's issues are that there's advertising dollars that are moving more into Facebook, believe it or not. I'm hoping for a more severe sell-off ahead of their number, a bit of a shake and bake also, if you will. If it doesn't do that, it might not be as amazing of a setup for the long side. I've said this range. This was the day there was some news that came out. Another attempt at a washdown job didn't work quite as well for Facebook, considering it closed a lot stronger. But this range to me is really key. Anything below 106.52 is very iffy. Anything above 112.65 is bullish, is a go. There are some other key levels around here, this 109.28 and the 110.65. We're futzing around there. Look at this. Multiple holds of the 50-day moving average. Coincidence? I think not. Moves below the 50-day moving average have been met with buying, though, and now we've been having holds. So I guess you could play this long against the 50 if you want. Any close below the 50 to me would get a little bit more iffy here. You really should not be seeing it move below these lows, below these 109s, so to speak. Below there could see a move considerably lower, maybe even back down to the lower end of this range near the 96s to 100 area. I'll probably use the opportunity in Facebook to sell some out of the money puts. I had said back up here, this is really where the big bet came off, or where you should be taking the big bet off. And then this was also another area to book some profits. So, you know, it's. I think longer term, Facebook is destined for considerably higher. You can see 200 MA also, by the way, has been very important support. That's roughly down into that region that I was talking about, near trend. I would love a opportunity to buy it down into there. Anyway, that being said, I think that Facebook's destiny is much higher longer term, but where we are given in the range, the risk reward isn't as good as it has been in the past. So I would like to see either the 50 hold and this move up strongly through this range high for a buy, or to wait for a pullback to trend. I will likely be selling some puts, assuming sell-off, ahead of their quarter. If it rallies up, I'll be booking more profits, is the most likely scenario. Given, by the way, how FANG has been reporting, the N and the G did not do so well. I think that they are opportunities to buy Facebook. I think it's the best one out of all of them. Someone asked me on the stream, which is your pick for the year, what's the best stock? And I kind of gave the Frank Sinatra answer, stick with the girl you came with. I would like to stick with the girl I came with, which is Facebook, but I would like to stick with it from buying it lower. I think the opportunity would set up for this thing as a buy for a little bit lower. Alrighty, that's Facebook. Amazon also reports next week. What's the move on Amazon expected to be? Why don't I have that written down? I don't. I'm assuming it's large. Couple of things about Amazon. It got the gap fill. I discussed this in last weekend's video. You do have some poor highs here. You are roughly holding the 10-day moving average and the 119.45. As long as it can hold over 119.45, I would say it's still okay to be long. Anything below there, I think, can see channel low relatively easily, or one of these moving average confluences. I would love to get this thing on a move back down into like these 540 area on a trend touch, roughly around where these lows are, and like the 50% fib is. I think that would set up okay. Seasonally, this isn't the best time for Amazon. It seems to me like there's a little bit of risk here. When stocks, like I say, move down strongly, get into reference area, it could get a little bit squirrely. So I'd be a little cautious. I do think longer term, Amazon is destined for higher, for a gap fill here, but I will be a little bit more cautious now that it got my target here. People had asked me, I said be long anything over 585, looking for the gap fill, and it's here, so you got to stick by your discipline. The stock could continue to go higher. If you want to keep some on, please do, but I would use a little bit of discipline and do a little bit of trimming now that it got into the target area. Netflix. I called this one an outright short in last weekend's video. How right that was. You know what's strange? It's funny about Netflix. Some of my biggest short trades are in Netflix. For whatever reason, it's just been that way for years. I have a great track record shorting Netflix. This ran up, got to quite high. It got into some key levels here. The 110s is really where the breakdown took place. And this was a gap and go below trend. It's now just kind of bear flagging out. I know a lot of people are curious, when is the time to buy Netflix? So let's keep it really simple. 93s here are key levels. 92.38 to 93.55. I think as long as that area holds, I guess if you want to test it, I think we're too close to there. What I would love to see is it to break up over, like for a few days, consolidate down here, and then you buy it over that consolidation high, playing for maybe a move to or into the gap. If you have multiple days of consolidation below these lows, I think it's a short, and the stock could have quite a long way to go. I've talked in the past about the stock maybe getting down to the old breakout level of the 69.90. This was where the, let me show you on a longer term chart. 3 years actually might be enough. I keep forgetting I'm in a 3-year period. Yeah, look, this is really where this major consolidation took place, down in this area, and where the breakout took place, the big breakout. I'd love to see it come back down there and set up for a long. I don't necessarily know that you're going to get it, but look what we do have. We now have a downtrend potentially in place. I don't know that it gets the channel low, but, it could, and that could set up. I warned that people would think that this is a double top. That's basically what happened. You got to check back into kind of the neckline of the breakdown, and it's now coming down. So I'm not necessarily so geeked up on Netflix at the moment. I'm just sort of thinking this is a trade. If it starts losing these lows, I like it short. If you can get back up above these multiple consolidation highs, then I think you could get a fade higher, maybe to fill the gap. So that's how I will be trading the Netflix. The Google, I've talked about this being something I don't really mess with inside of range. I like to either short it at the channel high or buy it at the channel low. We are nowhere in that. We are just sort of in no man's land here. But let's keep it simple. We have an earnings day now. Anything above the high of day, which is 753.92. Look what's key here, 752.05. So anything above those high, that level and that high, I think is a fade for a gap fill. Google likes to do this, by the way. Gap down, fill the gap, and then go back lower. It's just something that I've seen this stock do many times. So I am on guard for a gap fill. Anything below the low of day here, 730.37, probably has some room lower, maybe down to this 682 level. It's sort of one of those fill up the triangle trades. So that's sort of the way I'm rolling here. It also was an old gap fill. It just seems like a logical place for bears to try to push price to. Microsoft. So this is one I didn't play long. I don't know why I didn't. I was bullish on the stock. To me, this actually looked like this was setting up for a break above. It did not. It went lower. You're below 52.25. Same setup as Google. I actually think that this is a better pattern than Google. This could even, believe it or not, set up as some type of an inverse head and shoulders and then power up. I think this stock really wants to see 60 at some point. I just don't know that it doesn't want to see 48 and maybe even 46 first. I'm looking to buy this one just either lower or higher. I think a move over the high of day, 52.42, is worth a row long for a gap fill. Anything below the low a day, I probably will just be watching. I don't know that I want to be short, but I would probably do put ratios, looking like buying some puts down in here or in here, and then selling 2 times out of the money in here at one of the fib levels. That's sort of what I'm looking for in Microsoft. Tesla pulling back. It got my price target. I talked about selling this sucker at 265. So we got there. It's pulling back. The pullback is rather shallow. Take a look at what's holding here, the 20-day moving average. If you want to be long, I like it against the 20-day moving average long. Anything below there is probably a GTFO, and maybe wait for the 50-day. I also would like put ratios in that on a move lower. Some of the other ones I've been watching, this Etsy, not really a stock I follow very often, but I am intrigued by this pattern. Low, lower low, higher low, and it looks to me it's looking like it's forming a bit of a rounded bottom. I don't know if I guess an inverse head and shoulders, but more of a rounded bottom. Anything below, above the 940 neckline to me is a breakout. I wouldn't mind buying it long versus the 50 for right or right out if there's a move, in here you want to buy, but I think it will at least see the channel high. So I'm first time ever actually positive on this stock. SBUX was another one that reported. I don't really have much to say about this pattern other than there's a regression line here. You're basically on it. I don't really see much in terms of this chart. I would like to buy SBUX lower or wait for it to kind of clear and make a move back to the old all-time highs. I'm actually a little surprised. I guess this was, a little bit of a lower high here, but this to me looked like it wanted to go higher, similar to Microsoft. I'm surprised it wound up resolving a little bit lower, but it did. Visa, I think, just ran a lot on Amex. You could see this wasn't met with sellers. It did initially, but it basically closed near the high of the day. Visa is pretty strong. Also a regression line in there. I'd be interested in buying this at one of the fibs. I guess you could say a bit of a double top, even though this is a slight bit higher. I would think that there'll be buyers in this on a move lower. There's also a progression line in here. We were getting close. I'm surprised it didn't quite get to it, but Visa would be a BTD guy a bit lower. Anyway, I think we ran long enough here. That's my story. I'm sticking to it. I think I'm going to wait. I want to see what these durable good numbers are, and I really do want to hear what the Fed says. I think if we could get the Fed out of the way and they are benign, I think like I said, my big concern with the Fed is where we are in the dollar range, and sort of the pattern the TLT is starting to make a little bit. This to me is a little bit risky because I think you could see a throwback here, and that would not bode well for the market. If this does break, though, and the Fed is dovish, it's all systems go. I think that would be a clear sign that the market wants to rally for the summer. It doesn't always have to be sell in May and go away, although last summer it sure was. If the Fed is hawkish and those numbers that I showed you on that page go up and you start seeing the probability of a rate hike becoming more likely before December, the market is not going to like that. It's going to be trouble. So the key is going to be to watch the expectations of rate hikes and how many are going to happen this year. I'll address this. I'm going to do a Periscope on Wednesday, so it'll be right after the Fed, special edition Periscope. Anyway, that's my story. I'm sticking to it. I hope this video was helpful. If you liked it, please leave some comments. Help me make it better. Thumbs ups are always nice. And please subscribe to the channel. That way you'll get notified when I post new videos, weekend reviews, rebroadcasts of Periscope, and special edition videos. If you're not following me already, I'm sure a lot of you are, but if you're not, my handle is @JustinPulitzer on Twitter. Have a great rest of your Sunday night and trading week, and cheers.